Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. In this video I want to go over the iron condor strategy. This is a good strategy for range bound stocks, not shooting up or down dramatically. You could get a good amount of premium because you're getting the call side and the put side on credit spreads. Essentially it's a credit spread on both sides, where you could use the same amount of cash as one side. If you do a 10 width spread, only cost you $1,000, or even a 5 width spread's $500. And it's a pretty useful way to use theta strategies to let the theta decay and then earn a good amount of premiums. And as you'll see, you could easily return 2 to 4% a month using these strategies. As always, like and subscribe, smash that button, leave any comments down below. I'll respond to all comments. Definitely help out supporting the channel. And let's get right to it. So I've been recently using iron condors on stocks that actually have earnings coming up. When I look at is positions that have a certain percent that they move after earnings, and then I typically double that. Usually the delta is around 0.05 or so. And then I sell a put credit spread and a call credit spread at the same time. And I essentially let those decay. Been doing those on weeklies. So pretty interesting strategy. It's been 100% success rate so far. Fingers crossed. I don't know if that'll continue forever. But earning at least 4 or 5% for about a week, which is a very good return. And definitely a good strategy to consider. So let's go over how to set up the iron condors, some pluses and negatives to it, and then how to manage. Here's how to trade and manage an iron condor. So we're going to look at some main objectives for the iron condor, how to scan and look for the proper strike prices on an iron condor, and also how to manage the position as it goes closer to expiration. So first, an iron condor is a good way to sell premium on stocks or ETFs that do not move much up or down. We're going to be essentially setting up the iron condor where we don't want the stock to hit past our strike prices either up or down. So iron condors are good for range bound positions. So to set up an iron condor, you're going to do a put credit spread and a call credit spread on the same position and same expiration. Typically, you want the width of your strikes to be the same as well. You could do a 5 width or a 10 width spread, meaning let's say you sell 100 and a 105 call, or a 200, 205 as well. Okay? That'll be a 5 width spread. Some of the benefits of iron condors: it is a small cost to set up the position. It's only the width of the spreads, actually minus the premium received as well. So if you do a 5 width spread, then it'll only cost you $500 minus the premium received. So you can get started in a relatively low cost. One side is guaranteed to work in your favor. Since you're going above and below the current price, obviously the stock can't be both higher and lower at the same time. That'd be a little like Back to the Future, where the same matters at the same position at the same time might blow up the universe. Sorry, I went a little science teacher segue there. So obviously one side will have to work out. And then you also earn premium on 2 different spreads. If you only do one side on like a call credit spread, you make money on the one side if it works out. But if you're doing a put credit spread at the same time, the same cost as the width of the spreads. It's not going to cost you double to do these positions. And then you could earn possibly double the premium or really close to it when set up correctly. There are a few negatives to the iron condor though. You could hit the max loss as you're with your spreads, minus the premium received. So let's say you make $30 in premium off a 5 width spread. You would lose $500 minus 30 or $470. So that is your max loss if you get under one side of the bought, call, or put. They are a little tougher to manage because you do have to deal with 2 different positions, and the position can go against you 2 different ways. So if you're looking at 5 delta puts on both sides, it's really only about a 10% chance that one of those sides could get to near your strike price, and then you would have to manage them. So how to set up an iron condor: you want to find a stock or ETF that's range bound, and you use a standard deviation. Here on Thinkorswim, you could add the standard deviation channel under strategies, and then it'll show the range bounds on the market for that particular position. And you could sell a put and call credit spread. I like deltas of 0.05. You could try to challenge it near 0.1. If you go to 0.1, you'll receive more in premium, but it is a bit riskier and you'll probably have to manage them more. So those are some considerations to start out at very low deltas, because we don't want the stock to go above or below any of our strike prices. So how do you manage an iron condor? If a position doesn't go up or down, and let's say it stays at very close to the same level that you started position, I would consider buy to closing it at around a 75% profit. You do have to consider fees and commissions for doing these, because you have a lot of positions, buying and selling 4 different options, and then you would have to times that by 2 if you close those. So I'm looking for a little bit higher percent profit than some other positions where I might go at 50%. If your stock goes towards your put or the call side, you can leave the other side alone, let those expire. You'll be receiving the premiums on those. And then you could consider either a stop loss or roll the challenge side, meaning rolling out, possibly higher or lower in strike price, depending on if it's a call or a put, and then keep that side going for a later expiration date. Here's an example of an iron condor I'm considering. A 1003, Tesla's at $775. We're going to go really far above and really far below this strike price. So what you can do is sell a 500/490 put credit spread. What that means is you're going to be selling the 500 put spread and buying the 490. You're also going to do the call side, and you could do maybe 980, sell the call, and then buy the 990 call. And you can do this a month out for $11.05. You'll receive about $75 in premium currently on this position. The mid price is about 0.8, so I'm being a little more conservative for the 0.75. And then if you want to get about 75% profit, you could buy to close around $25. This will end up with $50 in total gains out of $500, which is your buying cost that it's going to take to do the position, or you'd make 10% in this particular iron condor. Okay, next I want to look at another possible iron condor for Pepsi. Pepsi is going to be showing earnings this week, so we're going to look at the expected move based on previous earnings on Pepsi, and optionslam.com is a good resource for this, and we'll see a possible strike prices you could do for an earnings play. So if you look at optionslam.com, this shows implied movement based on current options that might be moving in earnings that are coming up. So if you look at Pepsi right now, the earnings date will be October 5th, and then the weekly implied movement is 2.55%, meaning that during earnings it typically moves about 2.5%. And you can see in the last few earnings reports that it moves pretty close to the 1 to 2%. So we're going to double this and go to around 5% off. If you look at Pepsi, it's at 150.95. If you go 150 and then times it by 5%, which is double the weekly implied move, we're looking at about 7.5 difference from 150. So let's make that even more conservative and go up to 10. If it's at 150, we're going to look at the 160 call side, and then we'll also sell the 165. I'm going to go to 165 that we're going to buy. And then on the put side, we're going to go to 140. So again, 10 lower than the 150. We're going to sell the 140 and buy the 135. So you set up the position like you see down below. It does say iron condor on thinkorswim. And you'll receive an 11-cent credit, which is about 2% for a week. Now you do have to pay the commissions on it, so you're going to get another 240 down, but you're still possibly getting at least 850 on this position, which is over 1.5% in a week for a relatively low moving stock. So if you look at Pepsi here, these upper and lower bars are the standard deviation. Upper bars at 155, lower bar 148. We're going to go up to the 160 up here, and we're going below the chart at 140 around down there. So based on the standard deviation, if you're doubling that, there's a very low percent chance that Pepsi would be dramatically moving. It's also a dividend growth stock. Dividend stocks in general don't move as much as other positions that are more growth oriented. So again, if you're looking at another position to possibly do, we're going to go 10 lower, so 140 to 145, 135 on the put side, and then go up to 160, 165 on the call side. Okay, so there's my summary on the Iron Condor. If you have any questions, leave a comment down below. If you're interested in me giving possible recommendations on positions like this, if you might want to consider joining the Patreon, it's free for the month of October. And I do 2 cash secured put positions recommendations every trading day, as well as looking at different call put credit spreads and Iron Condors. And I'll link them out whenever I post them on my own personal account. So again, I'm the investing teacher, high school science teacher, teaching others how to invest. Be good out there, make money, and be good with the world. And I'll see you guys next time.